Hello, everyone, and welcome. If you're a tax professional, an accountant, or a business owner, you know the new Income Tax Act 2025 is right around the corner. It's time to get ahead of the curve. Today, we're going to tackle a really important piece of this new law, something you'll see all the time in real estate deals, Section 53. Let's dive right in.
All right, let's just jump into a super common situation. Picture this. A developer sells an office for, say, 2 crores rupees. But then you look at the stamp duty value, and it's 2.15 crores rupees. So what do? Which value do you actually use to calculate the business profit? Is it the 2 crores they actually got, or the higher 2.15 crores? This isn't just some textbook problem. This decision directly hits the bottom line, the actual tax you're going to pay.
So to get to the bottom of that question, here's what we've got lined up. We'll start with why this is even a problem in the first place. Then we'll jump into the solution, Section 53. We'll spend some time on the really critical part, the 110% safe harbor rule. We'll walk through a case study to see it in action and finish up with some practical tips and, of course, the key takeaways you need to remember.
All right, so that's the heart of the issue, right? You've got the price you sold it for, and then you've got this official government value, and they just don't match. Now, this can happen for all sorts of reasons. The market could be down, maybe it was a quick sale, whatever. But from the government's point of view, they need a reliable number, a benchmark, to make sure everyone's paying their fair share of tax. And that's exactly where Section 53 of the new Income Tax Act 2025 comes in. This is the section that gives us the answer. It lays out the exact rules for figuring out what the full value of consideration is supposed to be in situations just like this. Okay, let's get into the new framework itself. Now, what is Section 53 all about? Well, for all you seasoned professionals out there, I've got some good news. While the section number is new, the idea behind it, well, that's something you've probably seen before.
So if you look here, Section 53 in the new act is basically the new home for what used to be Section 43CA in the old 1961 Act. And this is really important because it means the core logic, the why and the how of it all, it's pretty much the same. So that should make the transition a whole lot smoother for everyone. But let's talk about why this rule even exists. What's the point? Well, it's pretty simple, really. The main goal of Section 53 is to clamp down on tax avoidance. To stop people from using unaccounted cash in property deals. By setting the stamp duty value as a sort of baseline, the law makes it much harder to underreport a sale just to pay less tax on the profit.
Okay, so when do you actually have to worry about Section 53? Well, 4 things need to happen. 1, there has to be a transfer of land or a building. 2, and this is super important, that property has to be stock in trade for the person selling it. Think of a real estate developer. That building is their inventory. This is totally different from Section 50C, which is for capital assets. And the last piece of the puzzle, the rule only kicks in if the actual sale price is less than the stamp duty value.
Now, before we go any further, just a quick heads up on some new lingo in the 2025 Act. You know how we always had previous year and assessment year? Well, forget them. They're gone. Now it's all just one simple term, tax year. So, for example, the tax year 2026-27 is the year you earn the income and the year it gets assessed. It's a small change, but man, it makes things so much clearer. All right, now we get to the part of Section 53 that you'll probably use the most in your day-to-day work. See, the law gets that things aren't always perfect. It understands that small differences in value can happen. And to handle that, it gives us a little bit of breathing room, a really clever tool called the safe harbor rule. And this is the number you need to burn into your memory, 110%. That's it. That's the magic number. Think of it as a 10% buffer. It's a tolerance limit that says, hey, as long as the difference between the sale price and the stamp duty value isn't too big, we're cool. It stops every tiny little variation from becoming a tax issue. And using it is super easy. It's just a 2-step check. Step 1, take your actual sale price and multiply it by 110%. Step 2, compare that number to the official stamp duty value. That's it. That's the whole test. And from that test, there are only 2 possible outcomes. It's pretty black and white. If the stamp duty value is within that 110% limit, so less than or equal to it, you're good. You're in the safe harbor. The tax department accepts your actual sale price, no questions asked. But if the stamp duty value is more than that 110% number, then boom, the stamp duty value becomes your new sale price for tax calculations. Simple as that. Okay, that's the theory. But theory is one thing, right? Let's make this real. We're going to go back to that developer we talked about at the start and plug in some actual numbers to see how this works.
So here are the facts again. We've got our real estate developer, the asset is an office space, and it's their stock in trade. They sell it for 2 crores. So first things first, we do our little calculation. 110% of 2 crores is 2.2 crores. Right there, that 2.2 crore number, that's our magic line in the sand. Okay, now let's play this out with 2 different possibilities. Scenario A, the stamp duty value is 2.15 crores. Well, is that more than our 2.2 crore limit? Nope. So we're in the safe harbor. The developer can just use their actual sale price of 2 crores for their taxes. Easy. But now look at scenario B. Here, the stamp duty value is 2.25 crores. Uh-oh. That is more than our 2.2 crore limit. So now, Section 53 applies, and the law says the sale value for tax is the higher amount, 2.25 crores. Think about that. Same sale, but a different stamp value leads to a totally different taxable income. See how that works? Understanding the rule is one thing, but making sure you apply it right is the other, and arguably more important half. So let's talk about some practical stuff, how to stay compliant and sidestep some common mistakes. When it comes to compliance, it's all about the paper trail. Number 1, always check the stamp duty value on the exact date of the agreement. 2, keep a copy of that registered sale deed somewhere safe. 3, and this is a big one, make sure the number in your profit and loss account is the same as the one you're using for your tax calculations under Section 53. And finally, if you ever challenge the stamp valuation, you better believe you need to keep every single piece of paper related to that dispute. Now, let's talk about the traps people commonly fall into. The number 1 mistake, by far, is mixing up stock and trade with capital assets. Just remember, Section 53 is for your inventory, Section 50C is for your investments. They are not interchangeable. Another classic mistake, just completely forgetting to do the 110% check and automatically using the stamp duty value when you didn't even have to. And of course, always make sure you're using the final registered values, not some number from early negotiations. Okay, we have covered a fair bit of ground here, so let's boil it all down to the absolute key points you need to walk away with.
So, to sum it all up, first, Section 53 is just the new name for what we knew as Section 43 CA. No need to panic. Second, this is all about land and buildings that are your stock in trade. Third, that 110% safe harbor is your best friend. If the stamp duty value is more than 110% of your sale price, you have to use the stamp duty value. And finally, and this is true for all things tax, document everything. It's your ultimate safety net.
And I'll leave you with this to think about. We all know how much real estate values can fluctuate, right? In a market like that, this 10% buffer isn't just a number. It could be what makes or breaks a deal, or what turns a simple transaction into a tax nightmare. So the question for you is, how is this 110% rule going to change how you structure deals and advise your clients? Definitely something to chew on.
Okay, thank you so much for watching our deep dive into Section 53. If this was helpful for you, do us a favor and hit that like button, subscribe so you don't miss our next update on the new act, and of course, share it with anyone in your network who might need it.
Just a quick reminder, this content is for educational purposes only and should not be taken as professional advice. Tax laws can and do change, so please always consult with your professional advisor before making any decisions. This is an AI-generated educational video.